Thanks for clicking! Canada's fixed mortgage rates continued to plunge downward in February, as mortgage lenders continued to trim their rate offerings amid previously declining bond yields.
It's now or never!
Indeed, as we'll see, 5-year fixed insured mortgage rates have been on a steady decline since reaching their previous high of 5.84 in October of 2023. Yet, as we'll see today, they could be on their way back up, as bond yields have risen almost 30 basis points since the beginning of the month, gaining even further momentum on higher yields coming out of the United States, brought on, at least in part, by both the Fed and some ugly Treasury auctions.
What are those?
Indeed, as we'll see, even though these Treasury auctions coming out of the US are having an even bigger impact on our own yields, and hence our mortgage rates, than even our own inflation data, Canadian media continues to focus almost solely on domestic developments. So what I want to do today is go over how much fixed mortgage rates have fallen in the month of February, take a look at what is happening in the US and contrast that with the narrative we're receiving from the media, and then discuss some implications going into the spring market. These Treasury auctions coming out of the United States, which we've been tracking since 2023, are no doubt going to continue to play a major role in the Canadian economy and Canadian interest rates for the remainder of the year. We'll obviously continue to track what happens with those auctions on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. Onto the mortgage rates. First up, my best 5-year fixed insured mortgage rate. In insured mortgage, that's where you have less than 20% down. You have a 25-year amortization. You qualify at the greater of 5.25 or the contract rate plus 2%, and you pay the mortgage insurance. My best 5-year fixed insured mortgage rate in December was 5.24. That dropped down to 5.09 in January, and as of February is now sitting at 4.89. with variable sitting at prime minus 1.05, or 6.15%. So that's a 20 basis point drop in the 5-year fixed insured mortgage rate, now sitting lower than it was back in June of 2023, when Canada's benchmark price hit its 2023 high of $755K.
The sky's the limit.
And insurable rates dropped as well. In insurable rate, if you'll remember, that's where you have that 20% down. You qualify at a 25-year amortization. You qualify at the greater of 5.25 or the contract rate plus 2%, and you don't pay that mortgage insurance. My best 5-year fixed insurable rate in December was 5.64. That dropped to 5.34 in January and is now sitting at 5.24, with variable sitting at prime minus 0.7 or 6.5%. So that's another 10 basis point drop in the insurable rate in just a month, down 50 basis points since December. And uninsurable rates dropped as well, though by not nearly as much. In uninsurable rate, that's where you have that 20% down. You have either a 30-year amortization and or do an equity takeout vis-a-vis a refinancing. You qualify at the greater of 5.25 or the contract rate plus 2%, and obviously you don't pay the mortgage insurance. My best 5-year fixed uninsurable rate in December was 6.14. That dropped to 5.62 in January and is now sitting at 5.57. with variable sitting at prime minus 0.25 or 6.95%. So we have insured rates down about 20 basis points, insurable rates down by 10 basis points, and uninsurable rates down by 5.
You can't afford not to.
And, if you trust the headlines, mortgage rates could fall even further, with the Financial Post noting that rates could dive further this spring. And, as for the reasoning behind this potential dive in mortgage rates, according to the Financial Post, rates could dive as they've held thus far despite rising yields. And prime is expected to fall 2% over the next 3 years.
Well, I'm convinced.
Which doesn't exactly match the headlines, does it? A, just because something hasn't happened yet doesn't mean it won't. You may not end up in the hospital the minute you jump off a bridge, but chances are you'll get there.
Whoa!
And B, what does prime dropping by 3% over the next 2 years have anything to do with what's going to happen in the spring market set to occur in a few weeks?
It's math. It's really not.
Regardless, these are the 2 reasons why mortgage rates could dive heading into the spring market, and the article doesn't mention anything whatsoever about the United States. Yet, as we know, yields have been rising since the beginning of the year, almost solely on US data. up almost 40 basis points since the beginning of February, with yields on the 5-year Canadian bond trailing close behind. And a lot of that rise in yields is coming directly from the United States. First, on comments from Fed Chair Powell at the beginning of the month that they were wary about cutting rates too early, and then on problematic, to say the least, U.S. Treasury auctions. While Canadian yields did get some encouragement on the news that Canada's inflation rate came in at 2.9% in January, they jumped back up on U.S. Fed minutes and weak Treasury auctions a few days later. And these Treasury auctions coming out of the United States, having a direct impact on our own bond yields and mortgage rates, don't look like they're getting any better anytime soon, with the 20-year bond auction last week being called ugly, showing very weak demand from investors. And when there is weak demand from investors at a current interest rate, that interest rate has to go higher in order to attract more demand. Basic economics when the money printer isn't humming.
I don't want to live in that world.
As we've talked about before so many times on this channel, there just isn't enough demand out there for US debt at current interest rates, and the amount of debt coming to the market is set to skyrocket, with the US running a $1.5 trillion deficit in 2024 and having to refinance another $7.6 trillion in the remainder of the year. And this thirst for debt coming out of the US is not something that is going to change anytime soon, absent a major change in US politics or a major cut in spending.
That's not going to happen.
Yeah, in the endgame to these problematic Treasury auctions, where there isn't enough demand out there for current levels of U.S. debt issuance, is finding a new buyer for U.S. debt, which would be the Federal Reserve. The endgame is the Federal Reserve ending quantitative tightening, resuming the purchase of U.S. government bonds, printing money to fund the U.S. deficit. And although the recently released Fed minutes show a Federal Reserve that at least says it wants to hold off on the purchase of new government bonds, the writing is indeed on the wall, and the Federal Reserve is set to start debating when they're going to end quantitative tightening at its next meeting, and the Bank of Canada will no doubt be discussing it as well. The question isn't if central banks will start buying up bonds again, the only question is when will they start, and what will be the effects? How will the market react when there's another buyer buying up US debt, but that buyer is the money printer, and that printed money will no doubt end up in the US economy, end up in the economies at large, which as we've seen can and does create inflation. And it's not just the United States. We're seeing report after report here in Canada of liquidity problems where the central bank has had to step into the overnight repo market, with predictions that the Bank of Canada is going to have to re-enter the bond market as well, start buying up Canadian bonds, much sooner than it thought it was going to have to. So the question becomes, what happens, how do the markets react when the central banks start intervening in the market again, when the central banks start printing up money to finance government deficits? We have seen the end of QT before. We saw this in 2019. We saw the Federal Reserve start buying up bonds after the repo market blew up in 2019, but we had a much different starting point back then, and inflation was much, much lower. When the central banks start buying up bonds this time, they'll be doing so, all things being equal, when inflation is not yet back to target. How the market will react to this potential new bout of inflation brought on by central bank bond purchasing remains to be seen. And I bring this up as this is incredibly complicated and no one knows exactly how all of this is going to play out. Yet, what we see in the media, what we see from the usual suspects, as it's just a matter of time before the Bank of Canada, the Canadian Central Bank, cuts rates, and then we're off to the races. As we've talked about so many times before on this channel, what happens in the US, what happens with the US Central Bank and US borrowing, and as we've seen over the past 2 months, matters much more to the path of Canadian interest rates to Canadian mortgage rates than our own domestic developments, even if US developments are continually ignored by the media when considering the Canadian interest rate story. So, Canadian fixed mortgage rates are on the downward path. They have been over the past few months, though developments coming out of the United States mean those days could very well be numbered. We will continue to track developments coming out of the US and their effect on our own interest rates, on our own mortgage rates on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.